Hey guys, this is Andrew again here with Ray Halstead. We're CPAs here in Mooresville, North Carolina. And today we wanted to talk a little bit about a profit and loss statement. We get asked a lot of questions about this from our new business owners. And a lot of times they just don't really know what they're looking at. And they just want somebody to help walk them through the process here so that they can see it the way we want them to see it, to be able to make informed decisions about what's on that profit and loss statement. So Ray, what can you tell us a little bit about the profit and loss statement?
So it goes by a different type terms. So you'll hear people refer to it as income statement. You'll hear them refer to it as profit and loss, P&L, statement of revenues and expenses. And what I'm going to talk about is basically from the standpoint of the small business owner, not your big corporation, right? So for the small business owner, the profit and loss is one of those statements that we use a lot to help manage the business. What that does is it shows your revenues and expenses that have occurred during a certain time period. Typically, we look at that time period on a monthly basis, and usually we'll take that 1 month and compare it to like the prior month or a month in a prior year. Or sometimes we'll look at it year to date to see how things are going year to date, and sometimes we'll just look at it on an annual basis whenever it comes time to do the tax return. But rarely do we run the profit and loss longer than a 12-month period. Your basic profit and loss is going to have two sections, right? You're going to have your revenues and you're going to have your expenses. For most folks, you're going to have a line for sales, or for any product that you've sold or any service that you provided, you're going to have a sales line. Some may have certain deductions from gross sales, as far as like returns and allowances and discounts, which will bring them down to net sales. So you'll start with gross sales. You'll have some of your deductions that bring you down to net sales. Now, depending on what kind of business you have, if you're selling a product, then you're probably going to have a cost of goods sold line as being your first expense line. If you don't sell any products, you won't have that. But we'll go ahead and assume you do sell a product, so you'll have what's called cost of goods sold. And what goes into cost of goods sold are all those items that it took to produce that product. Your labor, your materials, things like that go into cost of goods sold. So then what you'll do is you'll take your net sales and subtract cost of goods sold, and what that's going to do is give you gross profit. And that's probably a term that a lot of you have heard before, is gross profit margin. That's basically your net sales reduced by your cost of goods sold. So once we get your gross profit, then your next series of expenses are going to be what's called selling, general, and administrative expenses, sometimes referred to as SG&A. So you will hear that term thrown around a lot, SG&A. That's selling, general, and administrative expenses. And what that is those are your commissions that you paid sales reps. That's your rent you paid on the office space. Those are your salaries and hourly wages of employees who aren't involved in the production process. All that just kind of falls under that SG&A. So now we have your gross sales brought down to net sales, and then net sales reduced by your cost of goods sold, which gives you your gross profit. Your gross profit is then reduced by your SG&A expenses, and what that does is that brings you down to your net profit or loss. That net profit or loss is very important, right? Because it tells you whether or not the company is making money. A positive number is good. A negative number is bad.
Right.
Which, the P&L, which is what I typically refer to it as, is the P&L. Incredibly important from, tax planning standpoint to see how somebody's doing year to date, from being able to control expenses, especially doing comparisons from 1 month to the next to see if your expenses are going up or down, see if revenues are trending up and down. The profit and loss, income statement, whatever you want to call it, is an incredibly important tool in managing a small business.
Right. So, and you mentioned about the comparisons. If I'm a small business owner and I'm looking at my profit and loss that my CPA has just given me, and they've got it on a comparative basis, I guess what you're saying is I really should just be looking at different, what's gone up, what's gone down. I mean, my net income may be positive, but there may still be things that you can increase that net income number for. If your cost of goods sold are higher than your prior month or your prior year,
Right.
It kind of drives you down areas that need to be investigated to make sure you're
Absolutely. It helps you pinpoint areas to focus in on and drill down on and investigate as far as what's driving those expense lines to increase. What are the sales trends? There's a plethora of things that we get from looking at the profit and loss. So if you don't have a profit and loss for your business, I highly encourage you to start preparing one. Here at REH, we provide bookkeeping services for small business owners, and we will give you a profit and loss to help you manage your business on a monthly basis. So, if that's something that you're interested in, please give us a call and we'll help you out.
Yeah. So thanks for going through that with us, Ray. I think that's some really good information. There's a lot we can learn from just simply looking at a profit and loss statement about the health of a business. So it's important to have that for your books and records, and especially come tax time. So I appreciate it. Once again, this is Ray Halstead, Andrew McMillan, and thanks for listening to our video.